Fortress Paper is a publicly traded company. We trade on the Toronto Stock Exchange under the symbol FTP. We're also listed on the Frankfurt Exchange. We're also looking to slowly migrate the company over to be more of a senior listed company in Frankfurt. The company is predominantly, revenue is based in euros as well as our EBITDA and earnings, but we do currently report in Canadian dollars. Under some new accounting principles that are coming in 2011, we anticipate to start reporting in euros and again migrating the company over to more of a European shareholder base. One of the main questions I get asked by the analysts when they're covering our company, Fortress Paper, is what is the inherent value, or why is there an opportunity to invest in this company? What we find right now is that when you look at most paper companies, they're typically trading in the 5 to 7 times EBITDA range. These are companies with heavy debt burden, low growth profile, and potentially not leaders in the industry they operate in. Where we look at our company, we are leaders in everything we produce. We have a very strong balance sheet. We're definitely not in a net debt position, and we currently trade at around 3 times EBITDA. So we have very good value, yet a very strong growth profile. Right now we have 5 analysts that cover Fortress Paper, several of the major banks and several boutique institutional firms in Toronto, all of which are calling our stock a buy, and all of which have recently increased their target price. One of the main growth initiatives that we are working on is expanding our banknote production. Currently our machine runs 24/7, 365 days a year. We're trying to produce as much banknote paper as possible. We're constantly turning down orders. So we're just in the midst of implementing a new program to rebuild one of our paper machines. This will quadruple the size of our overall banknote production, and we're confident that that machine will be filled in due course. Fortress Paper just recently announced a record quarter for ourselves, both in terms of revenue as well as EBITDA. This has been the culmination of several years of hard work. We've more than doubled our EBITDA in the last 18 months. We anticipate that this will continue on at this stable rate for the next 6 to 12 months. Then once we finish the rebuild of our new paper machine, there'll be a dramatic step leap in both our EBITDA and revenue. When Fortress Paper went public in 2007, our wallpaper mill and our banknote mill was approximately equal share in terms of both our revenue and our EBITDA, each contributing about 50%. Since then, over the last 3 years, we've continued to grow our wallpaper business. We have put 3 new capacity increases at our wallpaper mill. We will continue to do more upgrades there, but they will not have the same impact that they've had in previous years. So we expect our wallpaper revenue and EBITDA to be able to maintain its strong position in the years to come. At our Langquart mill, there's generally been very little growth over the last 3 years, and that's due to the fact that the machine is completely full and we continue to operate it with full capacity. The change or the big move will happen on the banknote side starting in 2011 when we complete our significant upgrade of our banknote facility. This will increase our capacity by 4 times, and obviously 2011 and onward, we anticipate that our banknote or security division will far surpass our our wallpaper production. One of the challenges we face when we evaluate our market cap and when we have discussions with the analysts, we are a relatively new company to the stock exchange. We've only been public for about 3 years, even though the corporations have been around for more than 100 years in themselves. Right now, the analysts' biggest challenge, though, is our liquidity as well. The shares trade on a less liquid form, so to speak, than some of our comparables. And with the challenging times in the economic world right now, investors want to ensure that they can get in and out of a stock quickly if things change or if they have their own liquidity concerns. One of the challenges we face with the analysts is we're currently covered by 5 analysts, but these analysts are all in the forestry sector. The forestry sector has had a challenging time over the last 10 to 15 years. And again, we get lumped in with the rest of them, trading at the 5 to 7 times EBITDA, even though we're currently trading at a discount to that. The difference is we actually view ourselves more as a technology company, not a traditional paper company. Our products have a lot of inherent value built into them. While a traditional paper company might sell their paper for $800 or $900 a ton, and they buy the raw material pulp for $600, $700 a ton, there's not a lot of margin. We sell some of our papers for up to $40,000 a ton. When we look at Fortress Paper, again, most of the analysts lump us in with the traditional forestry companies, the paper, the pulp companies, trading at 5 to 7 times EBITDA, even though we're currently trading at 3. But our closest comparable, De La Rue on the London Stock Exchange, is trading at 9 times EBITDA. And there's several technology companies that are doing electronic passports and similar products that we sell that are trading at even higher multiples than that. And multiple aside, we also have a very, very strong balance sheet. We have a lot of capital on hand to further expand both our organic growth at our mills, but we're also looking at inorganic growth and numerous acquisition opportunities. At this point, Fortress Paper does not pay dividends. We view that there are numerous opportunities available in the market where we feel we can utilize the capital that we have on our balance sheet and provide a much better return to shareholders through share price appreciation rather than dividending the capital back to the shareholders at this point. I would probably guess that within 2 to 3 years, though, once we've taken advantage of several of these opportunities and the company's a lot more mature and we can't have this kind of step growth or significant impact on the company, then as a board we'll make those decisions, but we would probably implement a dividend at that time. When we look at some of the analyst reports that are out there, they're typically putting price targets that are anywhere from 30 to 50% higher than our current share price. We feel fairly certain and confident that as we achieve our milestones, those targets still have a lot of room to move up. One analyst recently put out a report with a target that was 50% higher than our current share price. And in their words, in their research report, they indicated they are still applying a 42% discount to our closest comparable when they come up with that number. So again, as we improve liquidity, expand our shareholder base, there's still lots of room for upside.